Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
Welcome to the Retirement Fiduciary Podcast. I'm Adam Koós, and I am the President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group in Columbus, Ohio. And today we're talking about why most retirement plans fail and the one big thing that every successful retirement has in common. Okay, so let's just jump right into the meat of the material here. First of all, I think it's important to understand that most people think retirement success comes down to things like investment management or investment selection, building a portfolio, diversifying a portfolio. Some people think that making as much money as possible, in other words, investing money in my 401k or putting money in a Roth IRA and just trying to grow it as much as I can with no real end in mind per se, but the goal being just grow it. Even others, although this is a minority, a small group of the population, believe that retirement success comes down to beating the stock market. Although there's a lot to be said about that, because when you say beating the stock market, of course, what market are we talking about? Are we talking about the U.S. stock market, the Toronto Exchange, the Australian stock market? Are we talking about international markets over in Asia? So there's a lot to be said for that too, and that's probably another discussion for another day in another podcast where we can get into things like home country bias. And if you don't know what that is, Google it. It's really interesting. So home country bias is worth a Google. But anyway, ChatGPT, that's even better. So these things that I just mentioned, they get a lot of attention, plenty of attention. But in reality, investment management, selection, diversification, growing your money, making it beat the market or not, but making it grow as much as possible, these are all secondary in nature to what really matters. Retirement planning is less about how much money you make and a whole lot more about how your life is funded year after year, both between now and when you retire. And of course, even more importantly, after your last paycheck, when you start providing yourself with paychecks going forward. So that's what really matters here. Now, savings is way more important than portfolio returns. So how much money you're making in your 401k, in your Roth IRA, your brokerage account, your IRA, whatever your investment vehicle is, or the type of account, your savings rate means way more than the rate of return and your growth rate. And here's why. Here's the analogy. I always use the same marathon analogy, that if you look at a marathon, if you run 26.2 miles and you're trying to get to the end of this race in one way, shape, or form, some people may think, oh, my rate of return is how fast I go. How fast do I finish the race? How quick is my time? But that's not true. The analogy here is that the market, the stock market, your rates of return in your portfolio, that's the wind, the weather, whether it's raining, whether you're going uphill or downhill. Most of us have been in some sort of race, not necessarily a marathon. I personally never even attempted to run a marathon, and I have no interest. That's just me. But most of us have run some sort of race, whether that's a 5K, 10K, something along those lines. And we all know if we run a race like that when we're going uphill, it's awful. We also know that when we're going downhill, it doesn't even have to be a steep grade. If it's even slightly downhill, it feels awesome. Same story goes when the wind is in our face. When the wind's in our face, it feels terrible. It feels like we're a parachute trying to make it through the wind. And when the wind's on our back, again, it doesn't even take much. It almost feels like we've got tailwind and we're a plane flying at 30,000 feet, and that makes life so much easier. If it's raining, all of a sudden our shoes get soaked, things are tough in a different way, never mind wind and elevation or grade. But my point is, that's the market. That's your rates of return. When we're talking about savings is analogous to putting one foot in front of the other. So every time you put money into your 401k for every paycheck, every time you put money into a Roth IRA, a brokerage account on a monthly basis through ACH or writing a check or what have you, every time you put money away for yourself, every time you save, every time you pay yourself first, as it's called, what you're doing is you're putting one foot in front of the other in the marathon race of your retirement, of your life. While returns feel good, and while it's always great to make money in the market and to see your portfolio go up in value, the analogy here is If you just stand at the starting line and you never put one foot in front of the other, in other words, you never save, but you just start with a lump sum and you hope the wind and elevation are going to blow you to the finish line, chances are you're not going to retire. So again, what matters most in the game of retirement planning and investing, financial planning as well, is putting one foot in front of the other, which is saving. So again, returns feel exciting, but savings is what truly makes work optional someday for you and your life, your spouse, your family. Markets don't send you a paycheck. The S&P 500 does not send you a paycheck. And the closer you are to retirement, the more crucial it's going to become, if you're not there already, that is, if you're not already retired, the more crucial not losing money becomes. Because you're not saving anymore. You're not putting money into your account anymore. Now you're potentially taking withdrawals. So now we get in the sequence of return the risk. And we're not going to get into too much detail about that today, but that is, again, it's way more important as you get closer and closer to retirement to worry about not losing money than it is to about growing your portfolio and shooting the lights out. So the life question and retirement shifts from how fast can this grow to instead, how does this support my life? So that's how things start to change here. Now, speaking of lifestyle, we need to start controlling fixed expenses because it's all about margin, not deprivation. I think too many times when we tell people about, I don't want to say budgeting because most of our clients don't live on a budget. I always say we don't really work with a cross-section of the economy. We work with a cross-section of savers. If you're a good saver, you make pretty good income, chances are then you're not living by a budget per se. Maybe some of you are, but the point here is when we talk about making sure we're saving, controlling our fixed expenses, it's not like we're trying to tell people to live paycheck to paycheck here. It's about making sure, in other words, it's not about deprivation, depriving ourselves of things. It's just being smart with our expenses. Like, for instance, I'm pretty passionate about this particular topic, but many times people will try to get into a 15-year mortgage because they want to pay off the house faster and they want a lower rate. There's nothing wrong with paying your house off faster or getting a lower rate. The problem comes when all of a sudden you lose your job and you can't afford the mortgage anymore, and now the bank wants to take your house instead of your neighbor's house. Here's the analogy, or not even an analogy, it's just a story. It's not a true story. I'm sure it's true somewhere, but the story goes like this. You have a $500,000 house. Your neighbor has a $500,000 house. You have a 15-year mortgage, and you're 10 years into your mortgage, and you only owe $200,000 on your house. So your house is worth $500,000, you owe $200,000. Your neighbor has a 30-year mortgage, and they're 3 years into their mortgage. They put 20% down. So let's just hypothetically say they owe a whole lot more than you, obviously, but because you only owe $200,000, but their equity, their percentage of equity in their home is lower than yours. If you both lose your job, which house is the bank going to foreclose on first? And the answer is the 15-year mortgage, the house with more equity, the house that they can foreclose on quickly, turn around, sell it, make a profit. It's less risk for the bank as opposed to the 30-year mortgage, which might seem more aggressive because most people think, I want to be debt-free. That's a good thing. And it is. But if you lose your job and you have no equity in your house or less equity in your house than on a relative basis compared to your peers, your neighbors, the bank's going to be more likely to let you keep your house for a while because there's more risk in trying to turn it around and sell it. So I tell people that unless it's your forever home, because there's nothing wrong with paying off your forever home. If you're going to live there forever, you pay it off, you own the home, that's not an issue. My issue is that most people who get into 15-year mortgages or who try to accelerate the payments on their homes, most of those people are probably not going to live there forever, and they're just going to end up selling it anyway, which means that all the money they're putting into the equity on their home, they're saying that's the best investment on the face of the planet. And not to mention, it's also one of the most illiquid investments on the face of the planet. The only way you can get that money back is if you sell the house or borrow against the home through like a home equity line of credit, for instance. So I'm going on a tangent here and I think I'm going off the rails, so I'm going to stop. But that's my point when I talk about controlling fixed expenses. We have to get creative here. We have to be smart. And sometimes what's smart isn't always easy to see. Let's put it that way. And I already mentioned paying yourself first. Paying yourself first is, I guess, what I would call a cliche, right? But it's very much alive and well and eliminates guilt. And this is how it does that. If we put one foot in front of the other, right? Remember the marathon analogy. If we put one foot in front of the other and we save everything we need to save in order to retire on time, make work optional, give ourselves the income and everything we need to hit every item on our bucket list at the age we'd like to have the choice to quit working. If we do that today and we have our plan put in place, we can spend money now guilt-free because we're already doing everything we need to do in order to either A, save so we can quit when we'd like to have the choice to quit working, or B, if we're already retired and we're taking a safe withdrawal rate, we can spend money and there isn't any guilt because there's a plan in place. Second is emergency funds. Emergency funds is kind of part of that whole guilt thing because oftentimes when people don't have an emergency account, and we always tell people to put it in a high interest bearing money market, something like Capital One 360. That's a perfect example. There's others out there. You can get some through other banks. So bottom line, it just needs to be high interest bearing and it needs to be safe, of course. We don't want to be aggressive with this money. But these emergency funds are in place to make sure that you can be your own credit card. If things go sideways in the market, if you have, an emergency that happens in life, as opposed to putting it on credit card and not paying interest, you can use your own money. If you're a dual income household, so both of you work, then 3 months of your expenses, so everything you spend every month times 3, is a kind of a rule of thumb for how much emergency money you should have sitting aside. If you're a single income household, then you can double that and make it 6 months. So roughly 6 months of expenses makes sense to be an emergency account. And then lastly, if you're retired, we use 12 months as a rule of thumb, and we like to call that gunpowder. In other words, gunpowder is when you're taking withdrawals from your portfolio, your retirement portfolio on a monthly basis to supplement your pension or your Social Security or both so you can live the lifestyle you want to live. And then all of a sudden the market starts to go sideways, not literally, maybe it's going down. So the market starts to crash. What we can do is we can turn off our withdrawals from our portfolio and let that portfolio take care of itself and regain what it's lost, let's just say, all while taking income from your gunpowder. And then when we get to the end of that, or close to the end of that 1 year, then we can just replenish it with what's inside the portfolio. But it's just a good strategy to help make sure that we're not liquidating our funds too fast. And that goes back to sequence of returns, by the way. When I mentioned earlier, Googling sequence of return risk, that's what ends up happening. You're taking a percentage out of your portfolio, but when the market's going down, the total loss between your withdrawals, the taxes, of course, if you're paying tax, which most of us are, and then the market decline can turn into a big dent or even a hole that's very hard to dig ourselves out of. Now, risk should serve the financial and retirement plan, not your ego. So what I mean by that is some people, because maybe they didn't save enough, maybe they started too late, maybe they've lived a really luxurious lifestyle that was a little over the top and they're not quite ready for retirement. Some have no choice but to take on more risk than they're comfortable with just so they can either keep up with their lifestyle, so they can catch up to where they should be in retirement. And that's unfortunate, but that's sometimes what we have to do. Usually we like to encourage maybe looking at our fixed and variable expenses, try to change our lifestyle a little bit. Maybe we extend retirement to a later date. Taking more risk shouldn't be the first choice, but I digress, because others, they have the choice. If they've saved enough in their retirement so far, they have what's called enough units of choice, because that's why I say money is a unit of choice. The more units you have, the more choices you have. So if they've saved enough and their retirement portfolio looks really good, then they have the choice to be a little bit more aggressive with, say, a portion of their money. But even then, we shouldn't be investing for excitement. We shouldn't be investing for ego, to shoot the lights out, like I mentioned earlier, because that's when we can get ourselves in trouble. We want to be investing in a conservative way, and you're probably doing it right if it's boring. But there are lots of different types of risk. Oftentimes we'll hear people say, look, we want to put our money in CDs because we don't want to take any risk. We want to put our money in a fixed annuity because we don't want to take any risk. There's risk everywhere. There's market risk, which is obviously the stock market going up, going down, volatility. There's inflation risk, which is the risk that inflation goes up faster than the money you're making at the bank, in a money market account, in a CD, in an annuity. When inflation goes up faster than the rate you're earning in this quote unquote guaranteed investment or safe investment, it's really not safe at all. You're actually losing money to inflation. It's just harder to feel that because the portfolio might not be going down. Longevity risk is where you live longer than your money. So in other words, living longer than your money lasts. Sequence of return risk, we've already talked about that a little bit. That's the withdrawals you're taking from your portfolio when you're retired. compounding with taxes, compounding with market losses occasionally. It's always temporary, but it happens. Healthcare, long-term care risk. Obviously, the rising cost of healthcare is no joke in this world, let alone this country. Interest rate risk. This is where we invest in something today and rates go up and now we're stuck at a lower rate. Liquidity risk. Talked about putting money into our house, paying extra on our mortgage when it's not our forever home. That's creating illiquidity, and it's putting money into an investment that might not necessarily have the highest growth rate in the world. Credit risk, default risk. This is investing in bonds, which people typically categorize as safer investments, but there can be default risk. These bonds cannot pay you back. That's happened before, many times. And then behavioral risk is probably honestly the biggest one. Behavioral risk, because we are human beings and human beings are such terrible investors because that thing between our ears always gets in the way because we are so emotional, and money is an emotional thing. That's something that can really get in our way as well. So risk management should be tied to a purpose. And it definitely, especially in this day and age, should not be driven by headlines, the news, what's happening in politics, or performance envy for that matter. So the worst retirement plans assume a static, linear future. They just think everything's going to be the same, nothing's going to change. But real life doesn't work that way, right? We all know that. Our health changes. Our goals change. They evolve. Our priorities change in life as we get older and we retire. Even in retirement, as we get older, things change. Family dynamics can shift. The worst retirement plans assume a static, linear rate of return. So just like I mentioned, the worst retirement plans, financial plans assume a static, linear future for us and our lives. The worst retirement plans also assume a static, linear rate of return. They assume if we make 4% per year from now until the day we die, if we earn 3% per year, if we earn 6% per year. But that's not how the world works. That's not how the market works. The market does not go up 4% every year, which is why a successful retirement plan is one that's built to adapt and evolve with our changing lives, with those tied to it, and all of it being stress tested against worst case scenarios, up markets, down markets, big markets, crashes. So all that's really important when putting together a retirement plan that makes sense. The best retirement plans, they're simple, they're understandable, they're explainable. The worst plans are confusing. They lack transparency. They don't make a whole lot of sense. When it comes to investments, there is a such thing as over diversification. People talk about diversification all the time. I always use the story or analogy of if we all owned a 100 stock portfolio together. So portfolio of $100,000 and each stock was worth $1,000. So equally weighted 100 stocks, $100,000. I would ask everybody, how many of you think if one of those stocks in that portfolio is Apple, how many of you think that Apple is going to go up 100% between now and the end of the year? Most people would not raise their hand. Most people would not agree that Apple's going to go up 100% between now and the end of the year. But humor me, and let's just say it does. If Apple is one of the stocks we own in a 100 stock portfolio worth $100,000 and Apple's worth $1,000, if it does go up 100% between now and the end of the year, all things held constant, what is our total return in our portfolio? And the answer is 1%. So we all agree that Apple's probably not going to go up 100% between now and the end of the year. But even if it did, we would only make 1% because we have so many stocks in our portfolio. So that's, again, a misconception here is that we can just diversify ourselves until eventually all we do is we just own an index. We've duplicated the market overall. Another one is advisors who sell more products to create more stickiness. We talked about this in another podcast. We talked about the topic of the podcast was how to spot bad financial advisors. But one of the things that some firms and some advisors do is they try to sell different types of products. Let's put people in insurance and let's do long-term care insurance and let's do a mortgage through the brokerage firm I work for, or let's do, T and a variable annuity and a fixed annuity. And so create all these different products for the idea that psychologically, the more investment types an individual owns, the more sticky they are, the stickier that relationship is. So there is a such thing as owning too much and keeping things way more complicated than they need to be. In other words, simple is usually best. And then if your plan only works when everything's going right, it's probably not the best plan in the world. And what I mean by that, as an example, is when you look at a diversified portfolio and you look at, say, the years between 2003 and 2007, it looked really good. You've got bonds doing pretty well. They're in the basement, but they're doing well on a relative basis. You've got small cap stocks doing really well because they're aggressive. We got real estate doing something different, but everything's doing well, but it's operating differently. It's just diversified. But then when you look at 2007 to 2009, the mortgage crisis, when the market crashed and went down almost 58%, all correlation coefficients came to 1, and the only thing that went up was bonds, and barely, by the way. Everything else just went down. U.S. stocks, international stocks, energy stocks, gold stocks, everything. So when you look at diversification, oftentimes it's only going to work when things are going right. So you have to do more, and you have to look at your financial plan in a different way. So I promised the missing piece. So the missing piece is successful retirement plans are not built on investment products, predictions, or performance. They're built upon a comprehensive, written, living, breathing financial plan that is revised as your life evolves over time. Now, what's this mean? It means retirement, income, investment planning, tax planning, risk management, insurance planning, and estate planning all working together in one harmonious fashion in your life. It's almost like becoming your personal CFO in your home, treating it like a business, so to speak. Then the plan is reviewed, it's revised, at least annually, stress tested and updated in each and every meeting. In other words, you don't have a meeting and just talk about the market. You have the meeting and you talk about your plan. You update your plan. You update your balances, your income. Maybe you change your goals. And when your life changes, the plan must be adjusted and follow your life, not the other way around. Everything else, investment products, investment strategies, these are simply tools inside the framework of the plan. In other words, these are just the tools that are used to implement the plan, but the plan is the Bible, so to speak. All right, one final thought here, just a quote. Retirement success is not about predicting the future. It's about having a plan that can respond, react, and adjust quickly to it. So with that all being said, thank you so much for listening today. If you'd like a second opinion on your retirement plan, your financial plan, your investment portfolio, please by all means reach out. Scan this QR code, go to our website, whatever's easiest for you. Obviously, check us out on social media. Look at our other podcasts, webinars, things that we're doing. I'm just trying to educate the public and let them know what's going on here. But otherwise, there are so many podcasts out there, thousands of them, and you chose to give ours a listen today. So thank you so much for tuning in, and we'll see you next time.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as a basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.